What if I told you that LNG prices have surged 30% this year? After a sharp 15% drop in the first quarter, the market has not only recovered but seems to be entering a new phase altogether. And the reasons behind this turnaround are more complex and more interesting than you might expect. It's not just about cold winters or tight storage anymore. Instead, a combination of resilient global demand, project delays, and renewed geopolitical risks are pushing prices higher, even as a wave of new supply looms in the background. Let's start with where we are now. JKM, the benchmark price for LNG in Asia, spent most of the summer trading between $12 and $14 per MMBTU. But recently, it's broken above that range, supported by stronger demand, competition with Europe for cargoes, and ongoing geopolitical uncertainty. Demand outside Europe has been surprisingly robust, especially in Asia, which is leading a rebound in global LNG consumption. Even China, which showed signs of weakness earlier in the summer, has seen demand stabilize. While some price-sensitive regions have scaled back due to higher prices, others have stepped in, effectively balancing the market. In fact, demand growth outside the EU in 2024 has already surpassed the combined growth of the last 3 years. From 2021 to 2023, non-EU LNG demand rose about 3% annually. This year alone, it's up 10%, thanks to stronger consumption in Asia. Looking ahead, that momentum should continue, albeit at a slightly slower pace. Morgan Stanley projects an 8% compound annual growth rate in non-EU LNG imports through 2028, starting from this elevated 2024 base. But don't be fooled, this growth isn't evenly distributed. Chinese LNG imports are actually down 25% year-on-year, due to high domestic supply, stronger pipeline flows, and weaker industrial demand. India and South Korea have also seen slight declines, while Japan has held steady. The only real standout is Taiwan, with imports up 10% thanks in part to nuclear shutdowns, including Monshan Unit 2, which is set to shut permanently in May. Europe is another key player here. The continent has recently imported about 35% of the world's LNG, up from 25% last year. Even with loosened storage targets, the EU still needs high levels of LNG inflows to prepare for winter, especially as pipeline gas from Russia becomes more uncertain. The Russia-Ukraine gas transit deal is set to expire in January 2025. If it's not renewed, Russian pipeline exports to Europe could fall by 50%, leaving Turk Stream as the only route. That would further tighten the global LNG balance. But if the deal is extended, or if a ceasefire allows more Russian supply to return, global supply could swing back into surplus, pushing prices down again. Meanwhile, the supply side of the market tells a more cautious story. While over 150 million tons per annum (MTPA) of new capacity is under construction, the pace of that expansion has slowed. Around 50 MTPA originally expected for 2025-2026 has been delayed or affected by sanctions, particularly in the US and Middle East. This has shifted the anticipated peak oversupply risk from 2026 to the second half of 2027 or even 2028. Global export utilization is also down. Seasonal maintenance has pushed May's utilization rate to about 87%, below the 93% average seen earlier this year. Projects like Snøhvit LNG, Hammerfest, and Gorgon are all offline for maintenance, while in the US, major trains at Sabine Pass are undergoing scheduled overhauls. On the bright side, new projects like Corpus Christi Stage 3 and Plaquemines are ramping up on or even ahead of schedule. What does this all mean for pricing? Despite the recent gains, Morgan Stanley still expects LNG prices to soften over the next couple of years, though with less downside than before. Assuming normal weather, JKM is forecast at $12 in 2025 and $9.50 in 2026. That's still around 15 to 20% below current futures prices, but also near the marginal cost of new supply. In other words, there's room for prices to fall, but not collapse, especially if demand remains solid and supply continues to roll out slowly. Now let's talk investment impact. In North America, even with some delays, US LNG export capacity is expected to rise 85% over the next 5 years. That helps support a bullish outlook for Henry Hub, with Morgan Stanley forecasting $3.75 per MMBTU in 2025, about 15% above futures. This benefits names like EQT and AR. In Europe, reduced pipeline flows and lower inventories mean higher reliance on LNG. This increases the correlation between TTF and JKM prices, and companies like Equinor benefit directly. with every $1 change in LNG prices moving cash flow by roughly 2%. In China, natural gas consumption is projected to exceed 420 BCM in 2024, driven by demand in the industrial, transport, and power sectors. LNG's share of imports might dip slightly from 59% in 2024 to 58% in 2025, as the Power of Siberia 1 pipeline reaches full capacity, but it's expected to climb to 67% by 2030. ENN Energy is well positioned to benefit from this trend. India and Southeast Asia are ramping up infrastructure, $150 billion in last-mile gas networks, terminals, and truck pipelines. Gas demand in the region is set to more than double by 2030, with rising industrial usage supporting pipeline players and producers like ONGC and GAIL. South America, on the other hand, continues to rely on LNG for peak demand due to infrastructure bottlenecks. Brazil, facing drought conditions, is importing more LNG, while Argentina has reduced its reliance but needs major investment in export-oriented LNG plants to reach full energy independence. YPF is leading that effort. In the Middle East, ADNOC Gas stands out as a top LNG play, with 12% of EBITDA tied to LNG volumes. Their recent acquisition of a 60% stake in the 9.6 MTPA Ruwais project, with 70% of volumes already contracted, helps limit spot price exposure and strengthen long-term earnings. So, what's the big picture here? The LNG market in 2024 has been full of contradictions. Prices are up, even though some key regions like China are down. New supply is coming, but it's taking longer to arrive. Demand is still strong, but growth rates will moderate. And geopolitical risks remain a wild card. If you're in the energy space, this is a market you need to watch closely. Thanks for sticking around. If you found this breakdown helpful, make sure to give it a like and hit that subscribe button so you don't miss future updates on global energy markets.